All right, everybody's favorite topic or most painful one sometimes, but happy to give you guys a quick kind of market landscape update in the way that we see it from the lending side and investing kind of in general. Um, I think both Ruven and I have been involved in this sector since its infancy, at least on the Amazon aggregator side of things, but also more generally the direct to consumer and e-commerce segments. So between market landscape, what it is, what it takes to get a deal done these days, and what is interesting from the lender perspective, things that we need to see, as well as structures, alignment, and a bit of a forward outlook. So I don't know, Ruben, if you want to frame.
I thought that was a good summary.
So I think we can turbo through the remedial course here. Everyone in this in this room, I think, has a pretty good understanding of all the challenges in the overall ecosystem and some of the opportunities that have been developing over the last couple of years. Overall, we've seen a massive influx of capital on both the debt and equity side in that 2020 ish context, and all for it to effectively evaporate as we saw too much capital chasing too few opportunities. At the end of the day, I think what always stands the test of time is good unit economics, right? So when we look at these things, we kind of say to ourselves, are you buying a good business? I think Ruben, particularly from the cash flow side of things, ourselves, we are asset-backed lenders, so we're always looking at what happens when things go wrong, right? And can we actually get at a decent recovery? It's clear that the large-scale shops that have gotten into this segment, are reeling, and I think a lot of the aggregators that have raised institutional money are continuing to work through problems. That seems to continue to bleed into the long term. From our perspective, leverage levels have obviously needed to come down. Acquisition multiples have obviously come down significantly as well, and structures of these deals need to be created in a way that allows for sustainability, allows for volatility. You get exogenous issues like tariffs, where I don't know where to underwrite to some extent. I just know that we need to underwrite to a substantial amount of stress.
I was just going to take a step back, just go
Sure.
into market landscape.
Yeah.
In a word, it's terrible, and it's getting. And there's a line of sight. There are inflection points that I think are going to be coming up, but it's actually been getting worse, not better. And this kind of the marketplace where things have really pivoted started in like 2022. We're still going through it, right? We're still taking supply out of the system. And you're seeing it finally starting where you're seeing some of the big lenders taking the write downs that should have been had, a year or two ago. They're still taking it now. At least that was announced from BlackRock and a few others. I think a few of the aggregators are going to file again in the US. They may go a second time around. And I think that we're going to need to see some supply coming out of the system, not of capital, but actually assets liquidated, taken out, tighten it, and maybe then we're going to see some of that inflection point. And I think, like you said earlier, which I thought was very astute, is the multiples just on the current, they should be probably going down to what was originally 5, 6, 7 years ago, when they were originally being acquired for, what is it, 1.5, 2 times SDE. And we're still seeing that happening. We're still seeing that kind of go down. So that's the current marketplace. It's terrible. It isn't getting better in the short term. But that also creates opportunity for guys like us, or at least for me. I mean, I like this stuff.
No, for sure. And I think when we look at what to market, and a lot of that comes with fund flows, right? How many buyers are actually interested? What's the landscape of actually interested buyers? I've heard and witnessed, a lot of brands that had sold, and those operators that have sold to the aggregators, they're going back in and buying their businesses back, and oftentimes buying them at pretty or very attractive valuations, only to know that they can fix them up pretty quickly and either post them back on the block, or just run them the way that they were running them before. So this is no different than any other PE cycle across a lot of different segments that we've seen. Um, it's the let's rule it from the ivory tower and assume that some financial engineering kind of fixes all the problems, when the reality is we know that you need to be maniacal about the day-to-day execution on these businesses. At least from our perspective, if you're a single channel, single geo asset owner, I think you bear a lot of vulnerability, right? And we've seen, whether it's Amazon or Walmart or any of the others, from a platform perspective, we do have a slide deck. We'll share it with everyone here, but we made a point to say you're a tenant, not a landlord, right? And so you are captive to whatever those
The whims of Amazon, or the whims of any of them.
the whims of any of them.
They change them pretty often.
Exactly. So that's it. From a buyer perspective, what we're seeing is there are some, smaller independent sponsors looking to acquire assets. The days of going out and saying, two guys in a dream, and we're going to acquire a large platform asset, that's a really difficult underwrite for us. I think what we are seeing is if you have an established platform, you are executing well on that existing portfolio. If you want to make an incremental acquisition that isn't a massive leapfrog event, we need to underwrite to the existing business, and we'll give some partial credit to, let's say, the acquisition target, but we need to see that coming in. So from an overall structure perspective, I don't know, Ruven, if you want to touch on
I
that.
was just going to say is that I think we say this all the time, but it really is here important is alignment. I think is really important. I want to see real money in. I want to make sure that you still have that. We're not in the business of giving kind of free options while we're taking, potentially the pain. And I think with what's happened, I think that's even more vitally important. And of course, seeing a real kind of, execution and operational plan other than the financial engineering that used to exist. But I'm sure everyone here knows that.
Yeah, the other thing we've seen from a acquiring perspective are strategic buyers. These strategic buyers are not buying commodity businesses, right? They're buying something that's defensible. And even then, I think they're being very opportunistic at what they can acquire, how that actually fits into their own strategic plan as well. But more often than not, you see family office groups or others that have a portfolio of these things. And, to some extent, I remember back in 2018 when we first started financing this whole segment, I had one group that had been running assets in the space for a decade plus. And they kind of said to me, these guys are going to come in, they're going to leave too, very quickly. So all of those existing players, I think, are still there. They've seen, the ebbs and flows of capital.
But you're not buying for exit anymore. You're buying for cash flow now. That's the important thing. I think 3 years ago, people were buying thinking there was going to be an exit opportunity. No, you're buying for cash flow, and that changes the dynamic completely, and it changes your entry multiples and how you think about things.
Yeah. We don't have a ton of time.
Yeah.
So what I also want to touch on is like what structures actually work in the market today. I don't know, Ruben, if you want to take a stab, or I'm happy to.
No, yeah. I mean,
So I'd say, as Ruben said, we want to see skin in the game, right? I think gone are we will finance 100% of that acquisition target, and underwrite to the existing business as the thing that gives us comfort there. So I'd say 50 to 75% of the total, consideration is still very much in the ballpark of what makes sense, with eligibility that basically says like, look, if you're looking to acquire and do a land grab of assets, that's probably not something we can do. You're all familiar with the earnouts, the runaway earnout obligations that have kind of created a lot of indigestion in the lender community for these assets. Things that are capped, seller notes as well. Also, from the target company, any kind of business principles rolling over equity, making sure that they're longer term aligned in the opportunity as well. So all of those kind of make sense at reasonable leverage levels with EBITDA adjustments that are really for one time, not recurring type things.
Yeah, I was going to say is like at times like this, when you have this kind of these dislocations or imbalances, I always ask myself, do I want to be debt or do I want to be equity here? And with the current market context, I actually want to be equity. Why would I want to, versus a return? Why would I want to get 15 or 18% if I can buy these things at 1.5 times cash multiples and get money back. So structured right, that's where you want to, at least my view, right now. Um, so that's the way I kind of think about it. That doesn't mean that, I always put my like, value hat on. And so the question is, how do I, even as equity, how do I structure around that to make sure that I can kind of protect some of the risks that may happen here, or so, and the margin, create a margin of error. What happens when, Amazon decides to change their algorithm, or some of the other platforms, or, the big issue now, we have a platform out in Asia, and what's interesting now is that the suppliers, that the Chinese, Asian suppliers that are supplying all the same competitors, are now directly competing with the brands. They're undercutting, they're going around. I mean, that's a huge risk factor that you now have to kind of manage, through. That doesn't mean there isn't some kind of opportunity set or value out there. But my point being is, I think at like these kind of market contexts, I think it's more interesting to actually be kind of what I would say equity or even hybrid capital.
Yeah, it goes without saying that the single channel approach, it creates a lot of vulnerabilities. It's also a question of how prone are you to an attack if you have a commodity product without a lot of value to that brand, right? And I think the brand value creation is where a lot of folks have struggled to kind of create, whether it's one uniform brand across the entire portfolio of products or at the individual product level. So having that multi-channel approach, a certain portion of sales coming from a marketplace, but also direct, also wholesale, right? Other things along those lines, which is difficult for private label, right? Because why is some wholesale retail relationship going to go with your product versus another?
Yeah, I think having that diversified revenue or channel base, I think is more important, is very important. And unless you're at least 25-30% direct to consumer, I'm probably not interested, actually.
There also geographical, kind of expansion, and the previous presenter kind of highlighted that. Taking your domestic brand and going non-domestic. I oftentimes challenge those that look to come to the U.S. To kind of bring their product set or whatever their business is. Most hyper competitive market in the world. Sure, it's the law of large numbers, but Southeast Asia, right? Indonesia's got 250 million people, and rising demographics, other things like that. I challenge folks to see beyond some of the obvious like country territory borders and see where there's opportunities, because a market just has supply demand imbalance that's actually in your favor, because there are marketplaces that actually are friendly because they have not yet actually won within their respective geos and are fighting amongst themselves for that pole position as well. So expanding that opportunity set, I think, is also but it is operationally very intensive, right? It's hard enough to just manage these businesses domestically with all the black hat actors, with the et cetera. So
yeah, so just go forward. I don't know how much time we have. Yeah, so where do we see the kind of the go forward? I think we're going to have to see some more of these, if you want to call it FBA or just pure plat, come out of the market, get liquidated, get the brand out, get tighten, get some of that supply out of the system. I think we're hitting a pretty interesting, I think, also inflection point on where pricing and multiples are going to where they were originally, as well. Though the opportunity set go forward, I think just operationally is very different as well. I think someone mentioning agentic AI and all these other kind of changes that are happening. So I actually think that there's an interesting time, my view, kind of coming up. But I got to tell you, it hasn't improved in the last 3-4 years. It's actually gotten worse. There's less demand for the system in this product and market. And I also think you got to be looking at what you're really buying this for is cash flow, not some kind of exit multiple, not some kind of, IPO or strategic. You're buying it for the here and now. And I think that's a really important point.
Now, the one final point I'd say is, the market ebbs and flows. And well, for this segment of the market, you start to look at the stress fractures at the very high end of the private credit. You see the headlines about all these platforms like Blue Owl and et cetera. Not to name any one particular one, but too much capital had flowed in, right? When I left the high yield and leveraged loan world in the mid 2010s, it was because of all of the things that were going on in that market that I thought were going to lead to bad outcomes. Well, those same things are happening at the upper end of the spectrum for private credit. That's bleeding down into this, right, segment as well. And so, as lenders, we look at it and say the more borrower friendly the overall ecosystem is, the less potentially attractive it is for us at any pricing level, right? So um, for us, it just all comes down to common sense, right? You don't want to endanger your business by putting on too much leverage. It's certainly not something that we're looking to do either. So
Yeah, I think there's going to be less credit capital available for this if there is any right now. I'm not even sure there is, but I don't think it's going to change with a lot of the private credit leaving. I think we've reached peak on private credit as well. I think actually there's going to be more capital coming out of the system. And then when you look at this asset or this sector, people don't want to touch consumer or e-commerce at all right now. Very, very
uh,
few.
the only thing I'd say that's going for us in the e-commerce segment is that SaaS is starting to look really bad, right? So, no, it's true. A lot of the strategic allocators that look to us to be at the forefront of these markets are like, oh, well, we'd rather underwrite to real assets like inventory, AR, et cetera. So now all of a sudden it flows back in here. The silver lining is we have started to see companies. Whether it's platforms or individual businesses that have that durability in cash flow. Some of them didn't even feel the speed bump; they just kept doing what they were doing to begin with. And but it's very few and far between that we've seen a story get fixed through this cycle. It will happen, right? It's going to be those that are maniacal about operational execution.
By the way, we didn't mention tariffs, but I'm sure everyone here is pretty well aware of that. So I didn't think it was anyway.